Hello, in this lecture we're going to talk about depreciation recapture and how it can affect a business. At the end of this, we will be able to explain what depreciation recapture is, discuss potential tax effects of the depreciation recapture, and provide an example to illustrate depreciation recapture. As always, you want to seek advice from a professional when thinking about the depreciation recapture and how it can affect a business. We will be looking at a scenario here in order to see the effects of the depreciation recapture. We're not going to get into specific code sections. We're going to give the general idea of what depreciation recapture is, how it comes about, why the IRS would be justified to do it, and what the potential tax effects would be in general. In order to do that, we're going to sell this piece of equipment here. This being an equipment supposed to look kind of like a Dr. Seuss type of equipment where the raw material goes in here and we make widgets over here. But in any case, we're going to sell this piece of equipment. In order to see how this would be affected, how the depreciation recapture could happen, we want to go through the story of the equipment, meaning we want to start with the purchase of the equipment, record the life of the equipment, and then to the sale of the equipment. So before we sell this, we're going to record the purchase of it and go through this process. So when we purchase the equipment, we're going to say we purchase it for $500,000. So if we looked at our books here, $500,000 would be credited when we purchased it, and we'd put it on the books for the $500,000, that being the fair market value price. So the machine's on the books at $500,000. Why is it the fair market value price? Because it's a free market, and if we purchased it for that price, that's the value of it at that price. So that's what we have so far. We got the $500,000 on the books. Notice what we do not have. We do not have an expense down here of $500,000. We do not have an effect on net income, even though we paid cash. Even if you're on a cash basis, we do need to capitalize the machine and then expense it over a certain time period. And now, we may get an accelerated depreciation method, some kind of accelerated method where we get a depreciation expense related to machine in year one, but this concept will remain in that we put the machine on the books and then we depreciate it. So that's what we'll do next. We'll talk about the depreciation. We're not going to get into any specific depreciation, what type of tax depreciation or special depreciation. All we're going to say is that over the time period in which we purchased the machine to the date we sold the machine, we're going to record the depreciation for that time period. Now, what is depreciation? It's going to be the reduction of value to this machine. Now, note that as time passes, as years pass, we still have the same machine. The machine's not going away, but the value of something will generally deteriorate. Us recording the depreciation is recording the reduction in value of a machine over a certain time period. So we're going to say for the purposes of this problem that depreciation over this time period is $300,000. Again, I'm not specifying a year or a certain time period that it's over. I'm just going to say over the life of the machine from the time we purchased it to the time we sell it, there is depreciation expense of the $300,000. Now note where depreciation expense is. It's down here on the income statement. That means that we have a deduction basically for taxes, and that deduction is at ordinary income rates, and that's where the problem is going to be here. That's where the issue is. What type of rates are we going to have? There's different tax rates between capital gains rates generally and ordinary incomes. This deduction reduces the ordinary income, therefore giving us a benefit for the ordinary income rate. The other side goes to accumulated depreciation here. So there's accumulated depreciation affecting the balance sheet side. If we pulled in over all the other accounts, you might be asking, well, how is this related to the machine? Well, we got the machine on the books at $500,000. We've got the accumulated depreciation, $300,000. Therefore, the book value being machine minus the accumulated depreciation, $200,000. The reason we don't put the $300,000 here and just write down the machine to $200,000 is because we want to recognize the fact that it is just an estimate. The machine's still there. It's not like we have reduced the amount of machine there. It's still one machine, but we're trying to recognize the fact that it has reduced in value. Also note that this $300,000, like we said, for tax purposes, there's often accelerated depreciation and whatnot. The tax code is not designed really to have this machine recorded at book value. Oftentimes the depreciation rules on the tax code are designed to stimulate the economy or have accelerated methods. Therefore, it's very possible that the machine is on the books at $200,000 is reduced or below the actual value of the machine. That's the issue when we sell it. Now, of course, the main issue we're going to have here is recognize at this point that that $300,000 benefited us by being a deduction. Now, if we sell the machine later on, let's just say we sold the machine now at a later date for $250,000. What would be the gain or loss related to that sale? Well, the cash that we got is $250,000. The book value of the machine is calculated, as you recall, the cost of $500,000, that's what we paid for it, minus the accumulated depreciation $300,000, book value of the $200,000. So the 300 minus the 500 minus 300,000 accumulated depreciation gives us the 200,000 book value. That 250,000 cash minus the 200,000 book value means we have a gain of 50,000. So we have this gain of 50,000 on this sale. Question being, should that, now whenever we have a gain, obviously the taxes is going to want a piece of that. So that's going to be taxable generally. The problem is it going to be taxable at capital gains rates, often the case when we sell equipment, or is it going to be taxable at the ordinary income rates? Now, for the taxpayer, generally wants capital gains rates because they're usually lower than the ordinary income rates. IRS wants ordinary income rates because they're usually higher than the capital gains rates. Now, the IRS is going to argue, of course, for ordinary income rates. What's their argument? Well, their argument is this. The machine is really costing or has a value at this point of $250,000. Why? Because we sold it for $250,000 on a free market. Therefore, that's the amount it's worth at this point in time. The only reason we have it on the books at $200,000 is because we over depreciated it. We bought it for $500,000 and then we said that it reduced in value by $300,000. That's what accumulated depreciation is. Well, it didn't reduce in value by $300,000 because we sold it for the $250,000. So we over depreciated it, which is common for tax purposes because the tax code tells us to over depreciate it oftentimes with accelerated methods. So then the idea that we have a $50,000 gain isn't really the case here. What really happened is we over depreciated it. And when we did depreciate it, we got a tax benefit of $300,000 at ordinary income rates. Therefore, this increase or this gain of $50,000 should not then be taxed at the capital gain lower rates. It should be taxed at the ordinary income rates because it really just relates to this $300,000 deduction that we had. That's the recapture. That's the argument. If the gain doesn't change, the tax rates are the things that we're taking a look at, the difference in tax rates. Now, it could be possible that this machine went up in value, meaning what if we sold it for $600,000? We bought it for $500,000, we sell it for $600,000. Well, then the 100 above wouldn't be recapped. That could be taxed possibly at the capital gains lower tax rates. If we sold it for $500,000 exactly, then the entire $300,000 could possibly be subject to the recapture. That's going to be the idea. Now, it's not very often that a machine is going to be sold for more than we purchased it for because things do generally deteriorate in value. Now, if we look at the journal entry of this, how would we record this? It would be a straightforward journal entry here. We would have the cash would go on the books for the $200,000 if we got $250 cash, increase in the cash with a debit. We would have the machine would have to come off the books. It's on the books at $500,000. Therefore, we got to reduce it with a credit to the $500,000 to make it go to zero. And then we've got the accumulated depreciation related to the machine. That's also going to have to come off the books here because the machine is gone. $300,000, making it go to zero. Now, in order for the debits to equal the credits, we've got a gain here. The gain being a credit down here, there's the gain. So that's going to be the transaction. That's the journal entry. And if we were to pull over the other accounts, here are the other accounts. What's the issue here? This $50,000, it doesn't change from books to tax. It's not like the tax is going to have a different gain than the book amount in this case. Of course, if we had depreciation methods that were different, it would differ. But the gain is that $50,000. The issue is how are we going to tax that? At what rate are we going to tax it? Capital gains rates are lower and then the ordinary income. The taxpayer would hope to have capital gains rates. The IRS, who's probably going to win, who basically wins the argument, is going to have the ordinary income rates. The ordinary income rates are usually higher. The reason the IRS wants the ordinary income rates or feels justified to have the ordinary income rates are because we got a benefit of the $300,000 deduction in prior years as we depreciated it, and this $50,000 is really just part of that $300,000 over deduction we got in prior periods. The prior period deduction, we got a benefit at the ordinary income rates, usually higher rates than capital gains rates. Therefore, this recapture piece of that then should be a gain taxed at the ordinary income rates.